Hello there, I'm Mitch Goldberg. Welcome to another live stream episode of Be the Boss of Your Money, our first one of the year, our first one of 2021. Welcome back. So it looked like the stock market was about to take off, new records, continuing our winning ways. Our winning ways. By the way, folks, I'm using a new mic today. I wonder if you notice it. And if you do, please let me know. And I hope I'm coming to you nice and clear. So let's see what we could do. And why aren't I streaming to LinkedIn? Okay, let me I have to just change a couple of quick settings, add LinkedIn back because LinkedIn is like my main go-to thing. Okay, let's see. We're in LinkedIn. Okay, welcome back, everybody. Welcome to me. Welcome to you. Welcome to 2021. The day starts with a skyrocket up, new records, but the day ends in a whimper. We give back the ghost. And before you know it, we are just finishing. Well, we finished off the lows of the day, but is today a harbinger of worse things to come? So that's what we need to do. And that's what we need to figure out. And is today something that is more significant that we need to know about? I'm wondering if LinkedIn is having issues because I keep getting blacked out from LinkedIn. I keep getting a notification that says we're not streaming to LinkedIn. It looks like we've settled that issue. So let's take a look at today's numbers. We're going to roll the intro real quick, and then we're going to have a very good show. The point of today's show is to really give you some things to think about. Forget for the year, just maybe to get through the first few weeks. We've got a lot of news, big news events coming out, in particular the Georgia runoff tomorrow. And then we have to take a look at fourth quarter earnings. Okay, so that's what we're going to take a look at. Let's just run the intro, and that will get us going. Okay, and we're back. You're watching Be the Boss of Your Money. Welcome to our first episode of 2021. Quick count, by the way, I think I've done about 200 live streams. It is going really well thanks to you. And your time is very valuable, so I greatly appreciate that you are spending some of it with me. I've got a couple of things to talk about today, but first and foremost, this show is about financial planning, personal finance, investing strategy, economics, macro, micro, business strategy. You name it. Hey, by the way, you're watching me right now. Let me know what you think about the audio. If you may not have noticed, but I'm using a new mic, the Shure MV7. I really like this mic. It's really just a fantastic mic, and I like the way it sounds in the testing. But if you're watching this live, I would love for you to let me know. We've got a couple of people out there. First and foremost, the best one of all. Hi, Daddy. I love you. I love you too, sweetie girl. Thank you for the shout out. That's my daughter. That's the best. I should just end the show now on a good note. Thank you, sweetie. And we've got a few other people out there. I know Judy's out there. We've got a couple of people coming in from Facebook, YouTube, and even from LinkedIn. So maybe we're back on track with LinkedIn. So here we go into the day. So what happened today is that the stock market started to go up, back to records as usual. We finished on record highs last week on December 31st. I just want to start by saying, just because the calendar changed to a new year, just because we went from December to January, that doesn't mean everything with the stock market has to change. Now, I understand that there are times when people want to make changes to their portfolio, but I don't like to make changes just based on the changing of the calendar. Trends that take place have nothing to do with the calendar. And I know some people are thinking about, well, what about taxes, tax loss selling, and people waiting for the new year to maybe take taxes on some of the big winners. I could see a little bit of that, but about 3/4 of all equities, of all stocks, are about three quarters of them are held in tax sheltered accounts. I think maybe, 25, 30 years ago, when I first got into the business 30 years ago, tax loss selling, tax strategies, they used to be a much bigger deal. But basically, mutual funds and most other institutional type of accounts, they've done their tax loss selling and made their adjustments typically by the end of October. I think today is just a reflection of a little bit of profit taking, whether if it was January 4th or December 31st, it doesn't really matter. We've got an election tomorrow, the Senate runoff election in Georgia. It's a big deal. It determines control of the Senate, and maybe Democrats will still get that blue sweep, or maybe Republicans hold on to the Senate. We'll see. And, I'd venture to guess who's going to win, but I think I'll leave that to the political pundits. I think they'll be better at predicting that. I'll just stick to the stock market. It's hard enough predicting the economy and the stock market. So that's what I'm looking at. Who's out there, by the way? Jeffrey Camelot. Whoa, yo, bro, give us the good news. Hey, man, good to see you, Jeffrey. I'm so glad you are out there. Well, a little note from Judy. Love you. Okay. Maybe we'll have to watch Netflix tonight. Okay. And you're amazing. Best friend, I love you. Let's go, Rockstar. It's my daughter. Keep up everything. Thank you, sweetie. So thank you for that. So let's take a look at the major averages, and I'll see if I can find the silver lining and some of the good news out there. Jeffrey, thank you so much for joining me, man. That is, I am touched that you are chose to spend a couple of minutes with me. We were going to do some share screen and pick the screen right here. So you see the Dow is off a little bit, 1.25%, S&P off 1.5%, NASDAQ off 1.4%. It's interesting. The NASDAQ and the Russell 2000 were both down 1.47%, and the VIX had a really big up day. That concerns me that the VIX is above 25, because that's been holding below 25 for a while now. Today's day in the market was the worst day since late October. And people are just trying to, I think, make a few last minute adjustments for 2021. But the trends in place don't change. I still expect, my base case is vaccines come out, people get vaccinated, we start living our lives again, we start coming out of the pandemic, people start going on cruises, they start going to the movies, they start going back to the gyms. I'm not saying that everything is going to go back to the way it was before the pandemic. So we'll still be doing a lot of remote working from home. There'll be a lot less movie theaters, a lot less restaurants, unfortunately. But by and large, when the pandemic ends, we get back to that, experiential economy. That's a good boost for the back to work, economically sensitive stocks. So that is, I still think that takes place. What's happening today is this is a reaction, I'd say a latent reaction to two new strains of COVID, one in England that's already reached the United States, and there's one in South Africa. So people are worried about those, and will the vaccines still be good? And scientists say yes, no problem. Plus, with RNA vaccines, you just simply take out the old genetic code and swap it in with the new genetic code, and you've got yourself a brand new vaccine very quickly. So that's what's happening. So, by the way, the Russell 2000 was down 1.5% today. That is small cap stocks, companies that are smaller in nature. They're typically more sensitive to the whims of the domestic economy because they are receiving more of their revenue from domestic, from stateside, as opposed to large multinational American companies, which get a lot of their revenues from overseas. Let's keep going. Today, it's, the FANG stocks, okay? The top 6 companies that are publicly traded. It's very difficult for the market, especially the S&P 500, to go up and the NASDAQ to go up when you have the biggest stocks all down. But Alphabet, that's Google, down 1.5%, Facebook down 1.5%, Microsoft down over 2%, Amazon over 2%, Apple down over 2%, and Netflix down over 3%. It's really hard for the market to surpass these stocks. And a lot of the economically sensitive, end of pandemic era stocks like cruise lines and airlines, those were down also. It was just basically an overall rough day for the market. Okay. So just something to take a look at. I want to see if I could switch this to the sector ETFs. Okay, that worked pretty quickly. So energy was the only sector that was up today. If you believe the economy rebounds, you want to be in energy stocks if that's your belief. Energy we pumped out too much oil, but there's been a lot of underinvestment in energy because the price has gone down so much. So it could take a while for production to come back up and meet demand. If the base case scenario happens, where the second half of 2021, we start to see a really strong economy. The worry is that if the economy gets too strong, will the Fed have to raise interest rates? Or will the Fed say it's transitory and we're going to go back to base after we get that initial surge in demand? And then the economy gets back to base and inflation starts to come down again. This is what everyone is going to be talking about, by the way. The story of the year right now is, does the Fed fall behind the inflation curve? And is the Fed even worried about the inflation curve? Because we'll go back down to a lower baseline once we get past the initial surge of everybody getting back to their life. At the bottom of the scale is real estate, utilities, industrials, technology. Overall, not a particularly great day for any sector of the market, but not a terrible day. I think we're going to have givebacks, pullbacks, and I think you need to get used to it. We've had a pretty easy market the last few months, but my opinion is we're going to get back to some volatility, and a lot of people have they're looking at their stock accounts, their 401ks, their regular taxable brokerage accounts, and you're looking at your accounts and you're saying to yourself, wow, I'm up a lot. Made all the money back easily from the depths of the bear market we had from last February to last March. Remember that 30 days market dropped about 35%, fastest drop of that magnitude in history, and everything's come back. So a lot of people are thinking, I have enough. I want to protect some of my profits, and I'm going to the sidelines. Here's how you make your decision to do that. Okay. You make your decision to do that based on your personal situation. You do that based on your personal finance, time horizon to your goals. If you have a goal coming up, is it in a year or two, 6 months, and you need your money out of the market for that goal? That money should already be out of the market. Money that you need for a near-term goal shouldn't be invested in the stock market. It should be invested in CDs, checking account, savings account, and other cash equivalents. That's how you should make your decision. Now, if you're an individual stock person, if you choose individual stocks and you're up a lot of them, then you have to decide that if your stock goes down a lot, how would that impact your account? And if you're saying that would be a terrible thing and I'd be very upset, well, then that's a reason to take some profits. That's your own risk tolerance. Here's a way that you could take some profits in a stock that I think you might find very helpful. You could put in a trailing stop order. So let's say you bought a stock at 80, it's 300 now. And maybe it could go to 305, 310, 311, up and up, but maybe it goes down. So maybe you say, I'll put in a trailing stop order 2% below 300. Okay. And every time the stock goes up, the trailing order, the limit order, will also move up. So if the stock keeps going up, you're still in, but if it backs off, your sell order is like a valve to release pressure, and you're automatically out of some stock. It's just a very good way to stay in a stock without having to sell it right now, and only getting out when you actually see a pullback, a sellable pullback, if you will. Another thing that you could do is you could use options. So one of the things that you could use options for is you could do a strategy where you could own an option, a long-term option, instead of a particular stock. Or if you're in a stock already, what you could do is you could sell a covered call. That's a very conservative option strategy. But what that basically means is if you sell the covered call, you're selling future upside to the stock for a small amount of upfront money right now. So if you get called away, you'll probably be getting called away at a higher price than where the stock is now. If the option expires worthless, you get to keep that money. If the stock goes down, certainly you'll keep that money. And that's just another way to go about it. But when you write a covered call, it does stop the time frame for tax purposes. So if you're in a stock for 364 days and you write a covered call on it, the next day, 365 days, you'll be thinking, oh, great, I'm in it for a year now. It's long-term capital gains. When you write the covered call, that stops the clock for the time that you have the covered call. Just want you to know that. A lot of people don't know that. So a lot of people get close to a year and they start writing covered calls. So that's my strategy. I'm sticking to it. We're going to talk more about my forecast for the year, what I expect, where I expect it, which sectors I expect to work. Jeffrey has a question. I hope you're still out there. Let's take a look. We should still be telling our children to invest in 401k and mostly S&P. Agreed. If you're a long-term investor and, Jeffrey, you have, I think your kids are college age, you're just out of college. So yeah, just keep investing in your 401k plan every month. And that is that is the get rich slowly strategy. If I tell you that you have, everyone starts with $1 million lottery ticket. You just have to wait 20 years to collect the ticket. But the lottery ticket works like this. You invest every month, you put money into your 401k plan, into other savings and investment vehicles, and the money just grows over time. It's not going to grow in a straight line, but that really is the strategy that we preach here. So that is a very important point you bring up, and I thank you for that. I'm going to end the broadcast now. What do you think of the audio? Do I sound okay? I like how I sound. I've got that rich, deep, podcasty voice. If you have any questions, let me know in the comments. And that could even be my new material for my next episode of Be the Boss of Your Money. Thank you so much for watching. Speak to you soon.